Hello and welcome to this episode of VCC TV. My name is Narendra Kapoor and with me today are Gautam Mehra and Bhavin Shah of PwC India. Gautam, Bhavin, thank you so much for joining us today.
It's a pleasure, Narendra.
Thank you
for inviting us.
Thank you. The pleasure is definitely all ours. We've been looking forward to this for quite a while. Gautam, if I can start with you. We went through the budget speech yesterday. We're seeing the stock markets react very positively to this. But from your own perspective, if I can ask you to give me an initial analysis of the budget from a bird's eye view, what do you think of it? Do you think it's managed to meet expectations, both that of the investor community as well as the government's own goals when it comes to revenue financing and expenditure?
The short answer, Narendra, is a yes. And I don't think I'll hesitate to say maybe a resounding yes as well.
Okay.
And it's good because of a long time, I think one can give a resounding yes to the budget meeting expectations. I must add the expectations were few, but they were certainly not simple. And if I can just summarize what the big expectation was, it was please increase the expenditure for growth and infra, but please do not increase taxes. Now that's easier said than done, and the push was of course towards disinvestment. And I think on all these counts, the budget has delivered at least or more than what was expected. The government also has rightly taken and announced a lot of measures which are non-financial impact, more around ease of doing business. And I would, if one reads the Finance Minister's speech, while one is used to the EODB, ease of doing business, it just came out as more an ease of doing budget.
Bhavin, if I can come to you now, one of the bigger proposals, one of the bigger set of announcements that came in the budget related to GIFT City and IFSC. Could you take us through these proposals? Could you just walk us through these proposals and what they mean for the entire alternative investment ecosystem, and not just the private equity and venture funds, but the pension and the sovereign wealth funds who have that India appetite, but who haven't had the sort of regulatory or government support to make that push?
Sure. So, Narendra, GIFT has over time gradually developed its regulations. So, over the last couple of years, they have put all the building blocks around to make sure that the funds have desired tax regime to operate in a manner that they were used to operating from, say, a jurisdiction like Mauritius or Singapore. So we have everything in place. Now, in fund industry, every fund manager would set up fund once in 4 years, 5 years, because they have to deploy the money that they raised, etc. So if you were to really start afresh, whenever the new fund, which is going to be set up maybe in next 2, 3, 4, 5 year cycle for the fund manager, they will set up their fund. And that would have taken at least 4 or 5 years for the entire fund industry to really create a proper ecosystem or presence, each of the fund managers in GIFT City. This budget has proposed a tax neutral relocation from wherever the current fund is based, from say Mauritius or Singapore or Netherlands or Ireland, wherever they are based, into GIFT City without any taxes. And that would be a huge push for a fund manager. In our conversations with fund manager, they were saying, okay, I've got Mauritius fund and then I'll set up in GIFT, there are multiple locations, blah, blah. Can government consider something like this where we get all our funds which are based in, say, Singapore or Mauritius to GIFT? So it's huge push to, this demand from the industry, and it's come through. So would be very, very beneficial for fund managers to really look at this. In the monsoon session, there was a change proposed where credit investors, we see a lot of debt funds coming into investing into India, given the entire opportunity around distressed play, etc. And investments made in credit from, say, Singapore or Mauritius are not taxable. At least when you make capital gains, and interest is taxable at concessional rate. And that was not the case when you make investment through GIFT earlier. In the monsoon session, there has been a new regime which has been set up where these credit funds can invest through GIFT City and get a tax regime which is very, very similar to what you get, or even better actually than what you get in Singapore. So for them, this is going to be very, very interesting. They can also consider, pushing their existing investments down into the gift entity and operate from there. To your question, Narendra, on sovereign wealth fund and pension funds, they have huge exposures now, direct exposures in India, indirect exposures through AIFs, etc.
Correct.
If they can consider consolidating all their investments through gift entity, it would be beneficial. I don't think there is a lot of focus on really developing that to attract them significantly. So they have got direct tax exemptions when they invest into infrastructure sector, etc. But it's a big open area for GIFT to really consider as to how do they attract these large investors to set up their shop in GIFT City.
Gautam, I was lucky enough to attend one or two of the webcasts that PwC India held yesterday following the budget. And I think one of the points that you emphasized on, and that we later heard in different sections of the media as well, was the fact that the finance minister used the words monetization and privatization in the budget. There's a lot of chatter going around about these two words. Could you help explain to our viewers what exactly these two words, what are the implications for these two words going forward? How much of a positive impact can we expect from them?
Sure, Narendra. Well, while in taxes, no news is good news.
Yeah.
As far as it comes to disinvestment, I would say more news is good news. If one just looks at the words privatization and monetization, and why are they different from disinvestment? Disinvestment does not necessarily lead to change in control.
Right.
Whereas privatization, the intent is to give over control.
Right.
And that's a big shift. When it comes to monetization, and if you compare that with disinvestment, monetization gives me at least the intent, clear intent, to make things leaner. And I think the finance minister herself referred to in a budget speech that we don't have the time and the space for keeping unproductive assets on our balance sheet. Something to that effect. And again, that's a very different mindset from just a pure disinvestment franchise, which was there earlier, which was maybe I come down from 100% to a 90% or 80 or 70%. Right? So to me, the use of these words conveys the intent. I recollect it was probably in 2014 when the Prime Minister just finished a US trip, and there were media reports that he did mention that the government's business is not to be in business. What they are at least stating in this budget is, exactly a realization of that. And it's great to hear it, because if this is the start of the journey that they are, really pushing for around privatization and monetization, it does mean a lot. Because they spoke about LIC, they spoke about oil and gas lines, transmission lines, land monetization, stadiums. And I think the only skepticism, if I would have, would be going by past history. How quickly can they convert intent to implementation?
So does the language here? So does the language here signal a greater intent than just the expressions that have been put forward by different members of the government in the last couple of years? Is the language very important here? Should we look at the language and say, okay, this time not only are they serious, but they are putting the first step forward. They're putting their first foot through the door.
Yeah, and not just the budget speech, but I don't know if you had a chance to see some of the post-budget interviews given not just by the finance minister, but other officials as well. I think the seriousness is coming through, the repeated message that a lot of work has been done on this front in the last year across multiple entities. A statement that two banks, right? It's not just about further disinvestment, but getting specific to say two banks and putting down names of other entities. And of course, using the words privatization and monetization, it does give a sense of something more specific and something more real and short to medium term.
Near the top, we spoke about how the debt fund situation in India has been improving, and how a lot of debt funds are seeing the appetite for investments in India. And I think we have to ask you about what the proposals regarding debt financing for infrastructure, as well as the setting up of a development finance institution, is going to have. I mean, can you walk us through that? Because not only does this signal intent, but it's also the government saying that we know the pain points you've been talking about in various symposiums and fora over the last few years. Come and put your money into the roads, into the highways, whatnot. Could you take us through this DFI thing and the infrastructure related parts of this budget?
Yeah, infrastructure. I was quite pleased to see the wide changes that were made on the earlier exemptions that were granted to sovereign wealth funds and pension funds for investment in infrastructure.
Yeah,
I think this is a sector that requires big ticket investments, long-term investments, patient capital. May not necessarily be aligned with a 5 to 7 year investment horizon that the non-sovereigns and non-pension fund investors typically have. It's good for them as well, but I would just think that this fits in more well with the sovereign and pension funds time frame and ticket sizes. Right? So clearly the changes that were made to remove the speed breakers that were coming in the way of sovereign wealth funds getting a complete tax exemption on investments in infrastructure. I think every single one of those issues were addressed, whether it was about investing through holding companies, commercial activity, participating in management. I'm not getting into details, but having been involved in some of these discussions,
sure.
It was good to see these changes coming through. I thought the more broad piece of DFI, whether that is the solution to the issues, very difficult to say, but it's certainly one of the solutions. I think the whole piece about saying recapitalization of bank, privatization of banks, setting up of this bad bank, so to say, these are all steps in the right direction. Cumulatively, they'll make a difference. Whether any one of them by itself is going to, really solve the issue, I don't think so.
The M&A ecosystem.
Yes.
The pandemic has led to a severe rise in, a good rise. A severe rise is also a correct phrase, but still, it's led to a huge rise in M&A deal making.
Yes.
But there has been a bit of skepticism around the announcements made. Could you walk us through those, please?
Right. Yeah. So clearly, M&A is going to be on rise for next few years on post-COVID scenario. We'll just have to wait and watch. But a few changes, I would say, there were certain court rulings, and these are all court rulings which are way back, like 8 years, 10 years back, and Supreme Court rulings, High Court rulings, which have in this budget, partly the ratio of the Supreme Court rulings and High Court rulings is reversed. One of that is the depreciation, availability of depreciation on goodwill. So when I buy a business, by way of say slum sale, or if I buy a business, I pay a lot more than the tangible assets value. That's for the goodwill. And I really spend money for it. When I spend money for it, I expect that I should be allowed deduction either upfront or over a period of time. So depreciation is nothing but just allowing deduction of that cost that I incurred over a period of time. Supreme Court way back in 2012 mentioned that you should be allowed a deduction of depreciation on goodwill by way of depreciation. And in all these transactions, again, there are so many buyout transactions we see in PwC world, where non-core assets of this, large business houses are being carved out, and we buy into those, and those are done by way of slum sale. The valuation also factors in the tax cost generally when you look at the future cash flows. And depreciation on goodwill was a very heavy component of deduction which was claimed by these investors in their cash flow projections. That is now going to be disallowed. So the valuations will now be that much suppressed. I'm just not going forward, right? In a way, this goodwill is now treated like land. So on land also, depreciation was not available in the past, and that was claimed as deduction only when you actually sell the land. So even for businesses now, goodwill will be treated as an additional item which will be available on the balance sheet. When you sell the business again, you will get a deduction. but not during the course of running of business, and it will increase the tax cost of the businesses, and thereby leading to suppressed valuations for investors. That's one big change which has come through. Second is slump exchange. Way back there was what we call slump sale, and there were court rulings to say slump sale is not taxable. The law changed and they said slump sale is taxable.
Right.
There were transactions of slump exchange and some very interesting restructuring. Right, it means I have a company, I want to subsidiarize one of my businesses.
Right.
That's okay. I'll put my business into a subsidiary and I'll exchange. I will get shares. Now that's not a sale to a third party. It's just restructuring within the group. I have not really made money. There were cases like that, and court said that should not be treated as slump sale because it's just an exchange, and some nuances around taxes, and they said that this transaction should not be taxable. After those court rulings, there have been several transactions and several court rulings which confirmed this time and again that slump exchange is not slump sale, and therefore slump exchange should not be taxed. And this was used again by businesses to put non-core assets into their subsidiaries, etc., etc. This going forward is subjected to taxes. So slump exchange will be subjected to taxes, and therefore one avenue for tax neutral restructuring is being reduced now.
I would like to take closing remarks from both of you. Bhavin, if I can take just some closing remarks from you quickly. Overall, do you feel there was any space where the government could have improved in this budget, where they could have said, okay, this will facilitate a greater ease of doing business? Is there something you feel that was missing, or are you overall?
No, there are always demands and demands, right? Means the representations go into hundreds of pages when it goes from say chambers, etc. So it's always more is expected. But I think overall, the big picture, the fact that the tax rates are not changed and there's no COVID stress, etc., has really helped. Also, push of infrastructure has helped on the business side. Economic revival, etc., would be much easier with the push in infrastructure sector. And gift related changes are just an ongoing thing. So every year you will find something or the other on gift city. It's a developing regulation. So that is very welcome move. I think overall it's a good budget. Can't expect more at one shot.
I kind of echo that. There would be a lot of ask, and especially the sectors that were in trouble were asking for specific help. And I don't think at this point of time you could fault the government for saying instead of going and protecting specific sectors, we use those resources to pump up the economy overall. And I'm saying that because from a COVID perspective, everything seems to suggest that this is not the end of the beginning, but probably the beginning of the end. And therefore, the worst is over. And if we just pump up the economy now, everything else should fall in place. So clearly that. But because we're talking to a group of, your members, I think a couple of things that were of interest to the industry. The safe harbor asset management rule, which has now been provided to fund managers located in GIFT City. I think the long-standing ask has been both on the private equity and public side, private and market public side. Why not extend this to these kind of relaxations to all fund managers across the country? Make in India, Ghar Wapsi, these are the things that it protects. The category 3 taxation, it was a small thing about getting certainty that will help mobilize, more capital, which is required for growth. And just like for sovereign funds and pensions, the large ticket size investors, I think again in infra, focused on that. I'm aware there were representations even from some other similar investors to say, get us on a level playing field, give us similar benefits. Tax, while it's not the deciding factor, as we've seen on the REITs and InvIT side, clarity, simplicity of taxation, and some kind of benefits does help promote these investments overall. So those are the closing remarks from my side.
Well, I think in terms of tax, no news is good news. And in terms of disinvestments, more news is always good news as well, because now you have those two extra words to look at. Bhavin, Gautam, thank you so much for taking the time out to talk with us today. It's been an absolute pleasure. And I really hope we can have you both on again very soon with us.
Thanks, Narendra, to you and all the viewers. Stay safe. We'll be in touch.
Thank you.
Thanks, Bhavin. Thank you. Bye-bye.